The Oakmark fund outperforming the S&P by about 2% in Q3. And during that period, the fund added 6 names while exiting 3 positions. Oakmark's portfolio manager, Bill Nygren, joins us to talk about some of those moves. Bill, good to have you back. Good morning. Walk me through the thinking on some of these.
Well, as you know, in the market this year, it's really been a 2-tiered market. Growth stocks dramatically outperforming value stocks. I think the spread through 9 months was something like 2,300 basis points. And Oakmark is a value investor. A year ago, we had purchased some of the beaten up above average growth names. And what you've seen in our portfolio throughout the past 6 months, including the last quarter, was we've been selling off the names that we had purchased, like Uber and Adobe and Workday. And the purchases have been much more traditional value names because they've underperformed by so much. CVS, Centene, Phillips 66, all single-digit PE companies that are returning a lot of capital to shareholders. We think they're great businesses. And at single-digit PEs, a lot can go wrong, and we still don't have to lose money.
I thought Cisco was interesting as well. Networking becoming so important to the IT stack. Can you just talk about that one?
Right. I mean, from early in my career, Cisco was one of those stocks that traded at such a high multiple. You knew it was a great business, but the multiple was so high, a lot had to go right to justify that price. And of course, that's changed recently as Cisco went through some flattish years. We think they're on the path toward getting back to low to mid single-digit growth rates. And I think it kind of hits that spot that falls between the cracks, where a lot of value investors aren't comfortable buying technology stocks, and growth and technology investors generally don't want companies that are returning a lot of capital to shareholders. So we think Cisco is still a great business. We think most of their capital is going to come back to us, both as share repurchase and dividend. And if the company achieves the mid-single-digit growth rate that they're shooting for, we see no reason that it shouldn't get at least a market multiple, if not somewhat higher. And at the price we're paying for it today, that would be a great outcome.
We just talked about Capital One in the lead up to this segment. And also I see that financials are the largest weighting in the Oakmark fund portfolio, with about 41% as of the end of June. How has that changed? And as we look ahead to earnings season kicking off at the end of the week, which of course is including a lot of the larger banks, what is your expectation there, and how are you trading the sector?
Well, first, I just want to make sure we don't unnecessarily panic our investors. Yes, financials is about 40% of the portfolio, but well under half of that is traditional banks. There are a lot of financial technology companies that also end up in the financial sector, the way they get divided up. Our belief is that the banking industry is in better shape today than it's been in a long time. The quality of the assets on the balance sheet is strong. There's a lot of capital to support it, and the stocks are at a relative multiple to the S&P that's as low as they've been in about 30 years. Capital One is a name that we really like, leader in credit card services. And one of the reasons we like Capital One, it sells at about 7 or 8 times earnings, less than book value. But we think it's kind of a sneaky play on AI because Capital One has always been more advanced in their use of technology than their competitors. And they have explicitly said that they expect more of their processes to rely on AI and help them to lower costs and better the outcomes for their customers.